All right. Hey, Clark. So
Kyra.
how you doing? Good, good,
Good.
good.
How you
Good. So
doing today?
I'm doing good, man. I'm doing good. It is hot out here in Fayetteville, North Carolina, but I'm doing good. I'm doing good. Thank you for coming in to the Revelations of Real Estate. This
Absolutely.
is the first of many for us where we just want to, reveal some things to buyers, sellers, just the whole media and help them, not be scared of what's going on in the market right now. So thank you for coming. I have Clark Howard with me. He is the branch manager of Bayshore Mortgage, correct?
Yes.
Yes, sir. So, introduce yourself a little bit.
So I'm Clark, branch manager at Bayshore Mortgage Funding. We do loans all over the place.
Okay.
We do everything from first-time home buyers, uh, uh, first-time home buyers, the edit this part out. I'm sorry.
No,
I
you're
just
good. You're good.
we do everything from first-time home buyers to the people that are moving up, second homes, investment properties, land purchases, you name it. I pretty much have a
So you
home.
do it all. You do it all. And
Exactly.
yep. So this is my go-to lender. I always let everybody know that you're the best guy, I believe, in the world for mortgages. And because
Thank
you
you.
take people step by step and you
Exactly.
educate them. And that's so important. That's what I try to do, with me creating relationships, selling real estate. We want to educate people on one of the biggest purchases, if it's an investment or if it's their first home or if it's their fifth home, right? Say, we've seen it
Absolutely.
all.
Absolutely.
We've
Yeah.
seen
I mean,
it.
that's the big thing. Education is very, very, very important when you're
Very
going through this
important.
process. And, everybody needs a little help, right?
Right.
Most people don't understand the real estate industry. They don't
That's
understand
right.
the mortgage financing industry. So it's important to try to teach as you're going along. And I think that's
Exactly.
what sets you apart as well. You do a good job.
Oh, thank you. I appreciate it, Clark. I appreciate it. So
Problem.
let's get right into it. Today,
Sure.
we're going to talk about I saw an article on by CNBC and it says mortgage rates fall sharply after negative GDP report and Fed's latest hike. So I said, hold up. Everybody's everybody's out here talking about, hey, mortgage rates are going up, going up, going up. No, this says mortgage rates have gone down. And
Right.
I said, look, I gotta talk to the man with the plan, the man who knows, because and I'm just gonna give you some of the things that I saw. It's saying that rates fell from they were at 5.54% on Wednesday and then went to 5.22%. And then on Friday, and this is as of like July 29th, they even went down to like 5.13%. And these are mortgage rates, everybody. So this is the rate that you would get for your mortgage loan, right, Clark?
Right.
All right.
So
So yeah, give us some. Go ahead.
let's back up a little bit first.
All
Let's
right.
let's talk about how your mortgage rate is determined.
Yes.
It's not a catch-all rate. Your rate is determined by your credit score, the loan
All right.
product you're getting ready to go into, the amount of down payment you have, what's called your loan to value on the house. So
Mm-hmm.
the more money you're bringing to the table, the less your loan to value is, the more
Okay.
likely you're going to have a better rate. Uh, there's just several different factors there, debt to income ratio, all sorts of things. So when
Okay.
you're seeing these numbers that they're reporting, you can't go in and just fully expect you're going to have that rate. It's
Okay.
range, it's around that rate.
Okay.
So we don't know what factors they use to calculate that mortgage rate that they're broadcasting.
Okay. 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 So like this is not like you're saying, this is not a catch-all for everyone. This is
Correct.
okay. Okay.
Correct.
So
This
that's
is this is
important.
just a general 30-year note rate, basically.
A general and 30. And now tell me, what does that 30-year note rate mean? Because
Sure.
we
So
want to educate them. So help them
absolutely.
understand.
So 30-year note rate is a fixed mortgage for 30 years. So when
Okay.
you lock into this rate, it will not change over the course of the entire loan unless you refinance it. That's the only time it would change.
Okay. So you're telling me, and let's play devil's advocate.
Sure.
So I got a 5.13% interest rate. It says 30-year fixed, but hold on, mortgage rates go down to 4.2%. I can't get that 4.2%.
Oh, you sure can. What you could do is you could go out and do a refinance. As long as you
Refinance,
made
right?
six
Okay.
monthly payments, as long as you're on time with everything, and as long as the interest rates are going down, it's
Okay.
definitely worth looking into. The only
Okay.
thing you have to consider is that you'll have to pay additional closing costs for doing that second refinance. But
Okay.
there's nothing stopping you from lowering your rate. Absolutely not.
Okay. Okay. And so I know you see this article too, and I know you're always on top of things, so tell me, like, what do you think about what this is about it, this coming out, and, what do you think about the article?
I think that they did a good job with saying it's falling. I mean, rates right
Yeah.
now are going down a little bit. So, the interest rates are not tied by the Federal Reserve, which is one thing I know that's went on this week too.
Hmm.
It increased the Federal Reserve index rate by 75 basis points.
Right.
So let's go into that real quick as well. So the Federal
Okay. Let's go.
Reserve basis points, that is tied to short-term debts like your credit cards, your car loans, things of that nature. That also helps with raising your APRs, APYs on your bank accounts, for example.
Okay.
So it doesn't really correlate to what mortgage rates are. Mortgage rates are driven off of a 10 Treasury bond generally.
Hmm.
There are some specific differences, but generally you can follow off the 10-year Treasury bond.
Okay.
That actually has an inverse effect. So as consumer sentiment is decreasing, the rates are going up. If if consumer confidence starts going down, the
Hmm.
rates go up. If it goes up, the rates start going down. So
Okay.
it's it's an inverse effect. And what
Inverse
you're
effect, right?
seeing right now is with everything kind of going on in the market, because the Federal Reserve is raising their rates, there's
Right.
less of a risk of a recession coming. There's also more possibility of this being not as long lasting as they had expected it to be. So
Right.
confidence is starting to sneak back up a little bit. As that's sneaking up, that rate's starting to come
Mm.
down. So, I think they did a good job by saying it fell sharply. Obviously the rates have gone up a lot this year. They are still a little high, but they have cooled off from what their peaks were earlier this year.
Okay, that makes sense. So I'm just gonna go back just a little bit.
Yeah, I threw a bunch of stuff at you.
Yeah,
So
yeah, but that's good though. That's good. So what you said there was the basis rate is based off of more of the what we like to call consumer debt.
correct.
Correct.
That's more
Okay.
driven off of short-term notes. That's correct.
Short
Like cars,
term
credit
notes,
cards,
right?
equity
This
lines.
right. As we like to say, depreciating assets,
Correct. Now, your
but
home equity line of credit is tied potentially to the Federal Reserve rate. So that would be the only appreciating asset.
okay, okay.
Correct.
And then our mortgage rates they go off the treasury,
Correct.
right?
10-year Treasury note.
The 10-year treasury note. Okay. Okay, cool. So we got that. All right. So let me, that was a lot of good information. Is there any other pinpoints that you want to, I was writing some notes just to pin some things out there. And is there anything that you want to like pin out that you said or?
I think the big thing to take away is whenever you hear, because there will be more of this coming, Federal Reserve rate hikes, that is
Mhm.
not meaning mortgage rates are going to go up. They could go down. We
Okay.
just don't know. So don't be afraid and don't pause your search thinking that, you're not going
Right.
to be able to get something because the Fed raised the rate by 75 basis points. That
Right.
doesn't mean we raised our rates by 75 basis points.
Right. So this is what I know, and what I was speaking with, I think with you about too, is that so the basis points really are just what the bank, how they loan money from, like from the bonds or from the hedge funds. Is that correct?
It's a
Or
little, I'm not a stockbroker, so that
yeah,
gets a little bit further out of my realm.
yeah.
But basically, look at it as your mortgage is a long-term obligation, right?
Mhm.
What the Federal Reserve is increasing are short-term overnight obligations from banks.
Okay.
So they're increasing their overnight lending rate to the banks. you know, the mortgages don't fall in that category. So that's
Right,
why
they
those
don't
are
fall in. Two
separate.
different ones. And that's why we tell people, like, just, tip. Mortgage is a different category. Once you buy your home, you take yourself to a different level when it comes to wealth building, when it comes to, you're not in just that consumer debt. You're now into an appreciating asset, and it is a debt, but like you said, it appreciates and it usually doesn't always depreciate. So
No,
I'm not gonna say no, because
it's a
things have been a
necessary
little
debt
different,
too.
but
Right. And it's a necessary debt too. We all have to have a place to live, right?
we all have to have a place to live. We all have to have a place to
And
live.
why
And
not build wealth in the process?
you know what? Why not? Like we say, instead of paying someone else, pay yourself.
Exactly. Exactly.
It's just as simple. Pay yourself. And that's the thing why we're educating people, is because everybody can do it. We all might not be in a mansion or a $500,000 home, or a $300,000 home, but everyone can do it at some level, and that's why we're trying to educate people. So
Yeah,
I
it's
do have
much.
a few questions for you,
Sure.
that we definitely wanted to ask you and get your opinion on, because I want everyone to understand this. Are you ready for some questions, or did you want to say anything more about this, this mortgage, how the
I,
rates fell?
I feel like I capped that pretty good. So
I
I'm going
think
to
you
let you
did too,
answer all my
Clark.
questions. I'm going to let you ask all the questions.
I think you did too, sir.